Now, I want to talk about where do these setups form. So in your journal, this is like a subtitle area for this video. Where do setups form? Okay, think about that for a minute. When you're looking for this idea that I'm sharing, the fair value gap, where would you expect them to appear in price? Obviously, I've been teaching you the run above an old high or relative equal highs. And if you're bearish, that would set up a scenario where the market goes up, sweeps the highs, breaks back down below the highs, short-term lows taken out with displacement, and then you go back through that displacement leg looking for a fair value gap to short into. That's pretty simple logic, isn't it? Well, visually, I want you to understand it. Okay, so that way, in your mind, I do this exercise all the time with my students. Can you draw out with a diagram, like if you were at work and you're trying to explain to your friend or coworker what it is you're looking for in price? Now, they're not going to understand what you're doing, but how would you draw it out in price or in a napkin with a pen or pencil? What would it look like? Well, you have obviously a level of relative equal highs, and we're just going to use that green line as an example of that. And price is moving towards it. Small little correction or so, and it runs towards it again. And then finally it runs through those relative equal highs. Okay. At that moment, as soon as it goes above it, you start panning back through all this price run in here and find the nearest short-term low. Because that right there is going to be your trigger. It's not that it goes above this old relative equal high and then goes down below that. That's not it, folks. That's not it. You have to see it go below that and displacement with an energetic move, take out a short-term low. That's how you filter out these trades that may not be high probability. So that area right there, as soon as you run above the relative equal highs, in your mind, you're looking for where's the trigger. Because until it takes out that short-term low, there's nothing going on. There's no trade there. There's no setup there. Then when there's displacement, that displacement leg in price action, that right there is your foundation to the setup. That's it. Once you have that, then you can go into that area and look for the fair value gap. That's the logic. That's the pattern. That's what you're looking for. This is if it's bearish. Now, if those relative equal highs would have been traded through this morning, I would have expected this scenario. Okay. Before it ran those relative equal highs, I was looking for, like down here, price was trading down into that area. I was showing you my interest today. I'm watching this where it was likely to go down to, this is kind of like the low. In my mind, I'm kind of using it as an example. What I was expecting price to do once it got down into that fair value gap that I was saying, I'm watching this, that little arrow. Okay, I showed that little gap. I was expecting this type of movement to set up the run above those relative equal highs. But there was no movement here to set up that run either. So two scenarios that I would have loved to seen develop just did not pan out. It just simply wasn't there. Now, I'm going to teach you another approach, and this is kind of like what I was expecting. And had it panned out this morning, if it would have gave the real setup, which it did not, I've already shown that, that little fair value gap that I was waiting to see a response in, it didn't do it. Just melted right through it. But if it would have done this, but this is going to be the sell version, okay? Just reverse it for the going long idea. If you have an old fair value gap above you, okay, so you have an old fair value gap and the market's below it and it's trading up and you're bearish, but you think it's going to go up to that fair value gap. The same logic when it trades up to the relative equal highs. Once it trades into that fair value gap, it doesn't have to completely close it. If it trades up into it, anywhere between here and here is good. Okay. If it trades above it, you can really make it simple and say, okay, the low of the fair value gap, treat that like the same logic that you use for the relative equal highs. Doesn't that make it simple and easy? That way you don't have to worry about how hard do I need to know? You don't need to know that because you're waiting for something to happen. What is that? Once it takes out the low of the fair value gap and trades in there, you go back through that leg and see, okay, here's what? There's that trigger. That's that shift in the market structure you're waiting for. Then you have the displacement leg. So once you have that, you can go back in and look for the fair value gap. Okay, so that's the two entry strategies for this model. There's no other way of worrying about what does it look like this. Now, visually, this is what you're doing. Okay, it's simple. And if it feels like it's not simple, watch this part of the video a couple of times and then go back and look at price action in live data and in old back testing. Go back and look at old moves and you'll see this logic is there. Okay, it's algorithmic. It repeats. Unfortunately, today, it didn't give me the setup to allow myself to sit down with you tonight and say, okay, this is what I did, because I was going to trade it. Okay, I was going to enter at the low, run the highs, go short, and ride it down that way too. I was going to do it, but nothing panned out. It didn't mean that the model's broke. It doesn't mean that the model's broke. It doesn't mean that I can't find winning trades. It just means that the market did not provide the structure to allow this to form. Does it result in a losing trade? No, because the logic wasn't utilized that would have put me in a losing trade. It never formed. This right here, reverse the logic here. Apply it. That's the homework. Apply this logic here. Does this appear in the fair value gap that I was drawing your attention to this morning on the community post? No. And no one can manipulate and say it was. It just wasn't there, folks. So, it's just a missed move. And there's nothing you can do about it. Except for beat yourself up and say, oh, I wish I woulda, coulda, shoulda. And that stuff doesn't make you money. And it doesn't take any more money out of your pocket. So don't do it. Don't waste time doing it. It's toxic thinking. So hopefully I don't need to bring up all this negativity anymore and address any of it like this, because I'm never going to entertain it in a video again. But I want to lay the foundation and provide my response to anybody that would think like this or say this, whether they're trolling, whether they are sincere, whether they feel like they've been victimized. Okay, you've done that to yourself. If you pushed a button and you entered a trade, you did that. Nobody in this community, including me, chief of all of them, never told you to buy or sell anything. You're never going to have instructions where I'm telling you to buy or sell anything. It's always going to be study this, observe this, watch this. That's what I'm saying. They're not code words for anything. They're specific elements of study. Put your attention here. Watch and see. Observe. Is there any characteristics repeating with the logic that I teach? That's not trading. Okay? That's not trade advice. That's not investing advice. That's not money management advice. It's just practicing reading price action. And that's how I teach. It might not be for you. Maybe you want me to drive around in Lamborghinis and lie to you about stupid stuff that ain't going to work in the market. That's just not what I'm going to do. That's not me. I do things in the charts that make sense. All right, folks. I'm going to take a look at the E-mini micro NASDAQ 100 index. Okay, and I'll show you the imbalance we're in here. This is the initial one. You can always imagine it could stab up into the second one, which it's really essentially just done now. So that could be a sell. I'd like to see it come down here first. And I'll outline this as I go. This is kind of like the end of the road for the drop down before it runs Tuesday's highs. That's what I'm thinking. This is FOMC. I waited a few minutes for it to do its initial shakeout. So this is the end of the race lower. That's the little checkered flag here. Notice I have that. So it's not like me talking after the fact. You can see I'm doing everything here. There's where we're looking for it to drop down in and run out the Tuesday highs that I was mentioning on my community post. So in other words, we're looking for it to trade down in there. Now it could sweep a little bit below that, because to the left of that imbalance that I'm highlighted in turquoise, there's the sell side liquidity pool resting just below it. But for now, I'm just focusing there. So it could drop down into that level. Now there's a couple ways to use this information. You can do a trade here with your demo account, compliance reasons, and look for it to run out the short-term low, and or wait for it to potentially trade up into the higher time frame fair value gap. And the reason why you could potentially wait for that is because it's FOMC. It has like a knee-jerk reaction, kind of like non-farm payroll There's an initial leg, then another leg, then like a fake out leg, and then a real setup comes, which is what I'm outlining here in that blue shaded area. So I'm noticing that it's likely to draw down here, so I'm drawing this out so that we can see the diagram is dropping, okay? The idea is to drop down here first. This is the quick move I'm looking for, then the run through Tuesday's high. Alright, so it should start dropping in here. I don't want to see it go too much more than that because that would upset the fair value gap that is not yet traded into. I think that's going to be the next real drop. So right here is where I'm thinking initially. There's sell side resting right below that low. So you could be a short here. And your stop would be right above that most recent green candle to the left of where we're at now. And you can see there's no replay button being used here. The candles are painting. The replay button is dim. It's not even a thing with me. Well, that's not true now, is it? I did recently in the mentorship video use the replay button, but I felt awkward and I just wanted to do it just to be funny. So here is the drop down in here. Now I can revisit the bottom end of that fair value gap and bump it, kind of like a support resistance idea. That would be a shorting opportunity if it were to do that. And again, the stop would be placed at the high of the most recent green candle to the left. Right there, see that? That's a short right there. Okay, the market is likely to keep dropping here. I'm looking for that little bullseye, that blue bullseye right below that short-term low. And that blue line, if you notice when I first started the recording here, that was really just an order block. So it could bounce there a little bit. But ultimately my interest is from where we are now down into that checkered flag area. And it doesn't look like I got enough room, so I'm gonna probably have to move that over to the right a little bit. And again, the mindset is we're dropping down. Okay, even though it really initially just ran the Tuesday high, but it's done it shallow. Okay, the vocabulary I'm using here is running the Tuesday high, not sweeping the Tuesday high. The difference between sweeping would be like what it's done here. That would be a sweep. That's a real shallow little run above that red line. That's Tuesday's high. Okay, so it swept that and we're coming back down post FOMC. So kind of like look at this move here we're making, and if it can drop down to that blue shaded area, it might just, if I'm wrong, it might just go down to that little bullseye and then run higher from there. I'm hoping it doesn't do that. I want to see it trade down into that blue shaded area where the little checkered flag is, because that's like the end of the race for bears. They get into that, then it should start the real move higher, running Tuesday high. Running Tuesday's high means it runs right over top of it and it just doesn't look back. Sweeping is where it just goes above or below a low or a high. You know what I mean? Like if we're going to sweep buy side, that means it's going to go up a little bit and then go down in reverse. Okay. If I'm saying we're going to run an old high or relative equal highs, that means we're going to run through it and continue. So that way there's a little bit of an understanding here what I'm saying when I say that. I try to pick my words carefully so that way you understand the distinction between what I'm expecting as a sweep and reverse back into the range, or expansion move where I think if we can get down here, and I'm going to scrub this over because you can see we're running out of space here. It might take a little bit more candles than I first thought. Oh, let me get this back here. There we are. Oh, there it is. This thing, I'm telling you, I look like a noob. ICT's a noob. Alright, so we'll see if we can drop down into that. And I had to make another video for my mentorship group, so I got to get started on that one. So here's a bearish order block. It can come back up and hit that and resume going lower. All right. Not bad, not bad. Let's see if she loves me. You can see, no replay button. Everything's dynamic here. All right, about to run into that sell side liquidity pool. Just anchor this here so that we can see visually when it drops below it. Change the color here. It's a little bit lighter than that one. Oops, too light. Okay, it's good enough so that we can see it. I'll take this off here. All right. And there you go. Now I'll come back to this in a moment. All right, as you can see, the market did in fact trade down. Look at the bodies of the candles respecting that blue shaded area. Really, really handsome price delivery. And it dipped down a little bit below, but that's fine. I'm not worried about being that accurate. The main thing is going down into that area, it turns and then runs Tuesday's high. Look how much more dynamic that is. Now, what I did was I took the low at the turn after it made its run into that little blue shaded area. Once it started rallying and it took out the swing high around that 13,150, basically crossed back over where the fair value gap is, the larger one that it dropped down into. Once it trades above that, then I'm going to use the high initially at the 2 o'clock hour down to the low post 2:30. That range I'm using the Fibonacci to expand up to a target, and it came up to 13,437 even. I'm just waiting for it to hit that, and then once it does, then I'll go into the Fibonacci and I'll show you, what this looked like, how I measured it and all that. But hopefully you can see that it's done the majority of the move, which was outlined on the community tab before I obviously did the video. I did the video here, marking it up that way you can see it wasn't a replay thing, it wasn't something after the fact. It's something that I'm teaching you all here. Now, the question mark at the bottom lower left-hand corner, what that is anchoring is the high that was formed at 2 o'clock, or what would be shown as 1400 here on the chart, down to that low where the question mark is. So what you're doing is you're going to get measurement of the range. Okay, where's 50% of that? Below 50% is where that fair value gap is, that's in turquoise. So that's the target, it's dropping down into it. So it's a matter of looking at this, and really there's technically, there's 1, 2, 3, 4, 5, 6, 7, 8. There's 8 trades in this whole entire thing. So once it trades this level here, I'm looking for it to hit that, and then I'll go in and kind of like show you some things about what I'm referring to as the 8 setups. And this might not be the real setup that you would be looking for. It might be one of the 8 that I'll show you. But that's the unique idea that I want you to adopt as a student of mine. I don't want you all thinking, well, we all have to have the same setup. No, you don't have to have the same setup. In fact, you're not. You're going to come to the conclusion that the things that you're looking for are going to be much more important when it's uniquely selected, not me pushing you into a mode saying this is how it's going to work every single time just for you, because it's not going to work that way. So you have to find a way to grow comfortable with the concepts and how that applies to the present market conditions and how you select your setup. And I'll show you 8 of them in here. That way you'll know that this is what you're looking for and it fits your criteria. And you may not take any of the other 7 out of the 8. But the main one here is obviously the one I highlighted. It's the one that is the highest form of analysis that we can see exactly where it's going to draw to before it turns around. So you can couple what I've shown you here with what I've outright came and told you basically that I'm looking for the drop down at FOMC at 2 o'clock. Once it drops down into that, usually around 2:30, it's finished its initial leg where it prices in whatever it's going to do, either a high or a low, and then starts to rally. So you can see it's pretty much close to that in terms of algorithmic delivery, just a little bit past 2:30. We're about ready to hit that target here, and there she is. All right, so let's dim that out, and I'll take you over to the fib portion, and I'll explain everything to you that way. All right, so now obviously I'm going to take you back in. I'm going to use the fib here, and what I'm doing is anchoring it to the high, down to the low. Now this is the most extreme. Now usually I'll use the highest open or close and the lowest open or close in the price swing when it's not expected to have a whole lot of volatility. Because it's the FOMC, it's more likely to be much more volatile. That means the extreme of the ranges should be considered. That means now I'm going to use the wicks. You get asked a lot all the time, you know, in the comments, like, you know, why does ITC use the wicks and why does he use the bodies and when does he differentiate? I just taught you. Okay, so I'll show you two forms of that, and actually I'll do this backwards too. I'm going to draw it from the low up to the high. I'm looking for upside objectives. Okay, so low up to high. Here's one objective. Here's two objectives. And now we're just falling short of that one. Okay, so that's kind of the extreme target for me today. But if you look at the body to body, it'll make a whole lot more sense in a moment. There's that target I was looking for there.